Ever pondered the workings of a mutual fund? Indeed, it's a business that amasses money from its patrons to invest in a variety of securities. A popular method for investing, particularly for the long term. So, how does a mutual fund operate? It collects money from its patrons, which is then invested in various securities by the fund manager. Profits or losses are equally divided among all investors according to their shareholding. But not all mutual funds are created equal. There are several types to choose from. Equity funds primarily invest in stocks. Debt funds, on the other hand, invest in fixed income securities such as bonds. Hybrid funds invest in both equity and debt. Index funds invest in stocks of a specific index. Lastly, sector funds invest in a specific sector. But how does one invest in a mutual fund? First, select the right fund in which to invest. Consider your risk tolerance when choosing a fund. Keep your goals in mind and select a fund accordingly. Also, take note of the associated fees and charges, known as the expense ratio. Mutual funds come with a plethora of benefits. Professional management ensures your portfolio is well managed by the fund manager. Diversification allows your money to be invested in various securities, reducing risk. And liquidity? Investors can sell their units at any time to convert them into cash. However, there are downsides to mutual funds as well. They are tied to the ups and downs of the market, hence the risk. Some funds charge fees for their services. Have you heard of a systematic investment plan, or SIP? It's a method where you invest a fixed amount at regular intervals to build wealth in the long term. One must also consider tax implications when investing in mutual funds. Different tax rules apply to equity and debt funds. So, to recap, a mutual fund is a business that collects money from its patrons to invest in a variety of securities. It's a popular method for investing, particularly for the long term. There are several types of mutual funds to choose from, each with its own pros and cons. A systematic investment plan is a method of investing in mutual funds, and tax implications must be considered when investing. And there you have it, the ins and outs of mutual funds. Now you're one step closer to becoming an informed investor.